Welcome to Mentoring Moments. Mentoring Moments is a sub-series of the eCommerce Edge podcast. It is composed of clips taken from Jason's one-to-one and group mentorship sessions. Hello, everybody. It's Jason here again with Sean Mellis on one of our one-to-one mentorship calls. Good to be with you again, Sean. And while we were off air, we talked about a whole lot of really cool stuff that you're working on in your business and projects you're working on and concepts you're working on and lots of cool stuff. But you also mentioned that there was some questions you had that might be more applicable to a broader audience, that might be interesting to a broader audience. So we decided to flick on the old recording and have a good chinwag.
Yeah, 100% appreciate it. So I manage an agency services business looking to launch a digital product, like a course or a resource. Just wanting to know the best way to go about that launch, where to find the customers for that product. Obviously, my existing clients and people who are following my content on LinkedIn. But in terms of more organic reach, paid media, just trying to figure out the best strategy to launch that digital product.
Yeah, look, it's a very good question. I think it's something that is hot. It's a hot topic right now. And if you follow somebody like Justin Welsh, for example, on LinkedIn, who is the solopreneur guru of LinkedIn. There's a few solopreneur gurus on LinkedIn, and I would say he's right up there amongst the top of them. I've never launched a digital product like that. I guess my services are a digital product, and so I've launched them through my own website as a subscription service. But in terms of creating a package or a learning module or a subscription to an asset, a video library, whatever it might be, I haven't done that before. And so I'm hesitant to give advice on something that is a little bit outside my lane. I always try to give advice based on something that I've either succeeded with or witnessed somebody succeeding with or had a hand in helping somebody succeed with, because I never want to be one of those people that tries to pontificate on anything and everything. Try as best as I can. Sure, I can maybe forecast and maybe crystal ball gaze a little bit on what might happen in the industry over the next 12 to 24 months based on my experience and patterns I'm seeing emerging. But when it comes to questions specifically like this, I'm at a little bit of a loss because I don't want to pull something out of my backside. And because I haven't ever launched a course, or I haven't launched a program or a membership program, or even created a program where people pay for access to a Facebook group, or I've never charged, for example, for access to my group mentorship program. I don't charge for that. It's free. And so it's just part of my content flywheel. It's part of my way of giving back to an industry that's looked after me for many years. And so because I don't really expect anything in return from that, it's hard for me to say the best route to getting that digital product to market. I know for me, it really has come down to how have I been able to build enough credibility through my personal brand, through primarily social channels. How have I been able to do that so that when I come out with something new, I've actually got a ready-made, interested channel that respects me, that trusts me, that when I maybe make an effort to quote unquote monetize. Now, I've never monetized my audience before, but at some point in the future I may. In some point in 5 years' time, maybe I'll decide that I want to put out a course. Or maybe I'll have worked, for example, with VCs enough in terms of consulting with VCs that I'll feel like putting out a course around how to interface with VCs as a consultant. Maybe that'll be valuable. Or maybe I'll have enough experience working with independent software vendors in 5 years that as a consultant that I'll be able to put out, because there's no content out there like that I'm aware of right now. And so I would want to put out something original that was based on my experience that I think would provide massive value to a specific niche target market, but I don't have that yet. And so I don't have anything that I think is so valuable from a training perspective that I could package that up into a module that I could sell for $20, $50, $100, $500. I just don't feel that I've got that yet. And until I do, I probably won't have the kind of advice that would be useful to you, unfortunately. But that's just me being as honest as I can.
No, that's all right. I'm curious to know if you've thought about launching a course and if you ever would, and what would it be on?
Yeah, look, I've considered it. And in fact, I've been approached about it on more than one occasion. And some of them have been professional course providers that have said, hey, could you come and do a module on X, B2B, or something like that, for example, that I have a particular specialization in, or solution architecture for e-commerce, or something like that. I asked on a number of occasions. I've always declined, not only because they usually wanted to just pay me like a one-off fee, and then they would continue to monetize it as a subscription forever, or for as long as they felt like the content was relevant to their customers. And I never really wanted to go to that much effort to create something that was ultimately the asset was going to belong to someone else, and I just got paid a one-off fee to record a few videos. I'd rather go direct to market with that content and give it away for free on TikTok or Instagram or LinkedIn. I'd rather give it away for free that then reflects all of that goodwill, because the money that they were offering, so let's just say hypothetically it was $5,000. Now, it wasn't $5,000, but let's just say it was $5,000, or let's say it was $10,000. I would rather chop that up into micro content that I can put out on social over a period of 1 to 2 months. And I'm going to get way, way more goodwill from the market than $5,000 or $10,000 worth of a one-off payment. And $5,000 or $10,000 isn't going to materially change my life. If someone was going to offer me $1 million to become part of a content program, then I'd seriously freaking consider it, because that's a life-changing amount of money. But 5, 10, 20, 25, 30, 50, $100,000, that's not life-changing money. And for me, I would rather stay true to myself and not monetize. So I'm trying to basically delay the monetization of my audience as long as I freaking can. And in fact, if I never monetize my audience, that would be like the perfect outcome for me. Now, sure, my content that might resonate with someone. A good chunk of my business comes through in DMs, where a piece of my content resonates with someone, and they go, "Hey, I think that I'd like to work with this Jason character. Let's DM him, let's tee up a call, and let's see if there's a fit." And that generates business. But that's not the goal of my content, is to go out and find that kind of person and say, how can I grab them by the scruff of the neck and drag them into my business? It's about how can I be a magnet instead of a lasso? And that's what I'm trying to do with my content. I'm trying to make my content a magnet, not a lasso. And I just feel sometimes, but clearly somebody like Justin Welsh, he said I think last year in 22, I think he said he did like $1.5 million, or it was well in excess of $1 million that he did in selling courses and content in 2022. So clearly it works. Clearly you can make a living off it. Clearly you can be very successful doing that and creating content around how to do that. And he's an example of that. But I think he is absolutely the exception, not the rule. Somebody like Shay Rowbottom, I know she makes a ton of money selling her courses and her training and her services. There's a handful. I can probably count them on 2 hands. I can probably count, out of all the people putting out this kind of content on LinkedIn, it's probably less than 10 people that are making a living off of putting out paid courses or content or training around what they do that can actually survive off it, as opposed to just having it as being a supplemental side hustle. Yeah, look, those are just my initial thoughts. I'm not saying you shouldn't do it, and I'm not saying you can't do it, and I'm not saying you couldn't monetize it. You might, particularly with performance media, if there's demand for the kind of content that you're looking to create, and there's already demand in the marketplace for that, and you can just capture the demand through performance marketing, as long as you don't have to pay the earth for it, then why not? It'll cost you next to nothing to do. I don't know how long or how much of recording you want to put into this, but you could test the water with a 15-hour, maybe a 10-hour or a 15-hour course that's video recorded. Maybe it's got some supplemental content that goes with it, or some supplemental documentation that goes with it, or some supplemental workbooks or something that goes along with it. It's not going to cost you, apart from some time and some post-production time, and then maybe pushing it out to Udemy or some sort of LMS platform that's out there that can manage all that, and the subscription stuff. It's going to cost you it might cost you $1,000 all up to try it out. So I'm always a big fan of trying and testing and seeing, especially if there's virtually zero downside risk. And this feels like something that's virtually zero downside risk to try.
Yeah, very, very keen to see the results. And I do want to increase the proportion of the revenue that's related to more DIY services instead of the done for you model, because there's a lot of knowledge and a lot of process that we've created over the years that I want to start packaging up, particularly for those who don't want to pay for the full implementation and want to get into it themselves or train their team to do it. So that's the thinking behind it.
And that makes complete sense, especially given the fact that, sure, some of the things that you guys do as an agency will require a custom developer and all that sort of stuff. But a lot of what you do is strategy and tactical work, and specifically how to leverage existing quote unquote out of the box platforms for best effect, right? And sure, you can't easily productize up, how to develop new functionality on top of a specific platform, because that requires a developer. But what you can do is all of your pre-work before a project of yours gets to a developer. That's the kind of stuff that is golden for repackaging all of your internal lateral thinking when a customer comes in and goes through discovery with you, for example. All the thought process, the collateral around the types of questions that get asked. Okay, if they give this answer, this is the type of thinking we would have. This is the kind of advice that we would give. This is the kind of services we would offer. I think that kind of stuff, that real nuts and bolts, practical application type stuff, that is the stuff that is your IP. And yes, if you can scale that and monetize that by productizing that into an easily consumable self-service way, then that feels like all that effort that you've put in over the last few years to get to where you are is much more scalable than the 1, 2, 3, 5, 10 clients that you can work with in a year.
Yeah, absolutely.
Awesome. Listen, man, as always, kick-ass questions, and I'm sorry that maybe that answer wasn't as encouraging as, or at least prescriptive as it might have been. But like I said, I like to stick to my knitting, mate, and I don't try to be all things to all people. So thanks for your, as always, awesome questions. Hello, everybody. I am here again with Jagmeet on one of our one-to-one mentorship calls. And he has some fantastic agenda items for us to cover off today that I thought would be helpful to a wider audience. So we thought we'd go on the record here and just chat pretty openly about 3 major agenda items. The first one that he's put forward today is holiday sales results and outlook. And so I'm guessing, Jagmeet, that this is mainly around retail. What do the retail results show? What does that portend for 2023? What do we think is going to happen in, say, ANZ versus the States versus other parts of North America, Europe, Central, South America, et cetera? So I guess that's what the key question was, yeah?
Yeah, no, you're right on track with that.
Yeah, look, I think it's interesting. I think there's still a bit of a disconnect between or a lag, which we know there always is a lag between rising interest rates and decreased consumer spend. And what we have seen, particularly out of data out of the United States and the UK, which they have some of the best data in the world on this, is the fact that spending has remained elevated, but more as a percentage of it has been based on credit. So in other words, average debt load per individual, particularly in the United States and UK, has gone up, which means that in most countries during COVID, for example, lots of people were getting stimulus checks. They were getting financial support from the government for their businesses. As individuals, they were getting tax credits. They were getting unemployment benefits. They were getting all sorts of things. And so therefore, savings actually grew during COVID because people weren't out spending necessarily as much as they traditionally would if they were out and about and going to malls, etc. So yes, a lot of spending did migrate from physical retail to online retail, but still it didn't fill all the shortfall. And as a result of that, during COVID, in most countries, the average net savings per adult individual in the country actually rose during COVID because people didn't spend all of the stimulus or all of the support that they got. They only spent a percentage of it. Now what we're seeing is, as COVID slowly comes to an end, although you wouldn't be able to tell that by the United States keeping their border shut until April, what we're seeing is that this rush back to retail, at least domestically, is causing people to continue to keep their spending high, even while people are slowly starting to lose their jobs, tens of thousands of layoffs in the tech sector, which are typically very highly paid in the tech sector. And as a result of that, the trickle-down effect on that, on the service economy and everything that orbits tech is being heavily affected. We are absolutely seeing that. But what I think is going to happen, at least based on all the forward-looking indicators that we're seeing across the major markets of North America and Northern Europe, et cetera, what we're starting to see is that it's more likely that this recession will be a bit of a double dip recession. So spending staying high for now, people living off credit, people maintaining their lifestyles on the back of heavy credit card spending. And then what's going to happen as the contagion of rising interest rates starts to impact people that are coming off of fixed rate mortgages, say, and the banks are refixing their mortgages at much higher rates. As a result of that, it's inevitable that discretionary spending will decrease. It maybe hasn't decreased yet, but like when we think of the typical type of mortgages that happen down here in ANZ, they're not typically the 30, 40-year mortgages like you can get in North America and parts of Europe. They're 5 years fixed, and then they go on to floating so that the banks can then get the current rates so they don't lose their shirt. So I think what we're going to see is we'll probably see a pretty significant impact of that by mid-2023, late 2023, at least in ANZ. I think we're going to start seeing the impact of pretty significantly higher interest rates than we've had over the last, say, decade. And as a result of that, I think discretionary spending the brakes will go on discretionary spending. So I don't think we've seen a tremendous amount of that yet because people are plugging the holes with debt right now, but they can't do that forever. And so as a result of that, I think we will probably see that by mid to late 2023. I think we're going to see a pullback in discretionary spending. How significant that is, I guess, is how quote unquote transitory this ultra high inflation is, and whether our central banks, which are trying to put the kibosh on the economies, put the brakes on the economy, take the heat out of the economies. I guess it depends on how long they have to keep interest rates at elevated levels. And let's remember that we still have net negative real interest rates in almost every country. So although technically they've raised interest rates significantly, when you back out the headline inflation rate, so if you've got 9% inflation and you got 5% interest, well, you still got negative 4% real interest rates. And as a result of that, those rates are still stimulatory. So we effectively still have interest rates subsidizing the wider economy and stimulating the wider economy. And if we have to get to positive real interest rates, which is typically what has to happen to really significantly cool inflation, if that actually has to happen, so in New Zealand, for example, if we had to go up from 4.75, whatever the heck it is at the moment, to 5.25, whatever it is at the moment. If we had to go from that to 9% real interest rates to be at parity with inflation, that would be a world of hurt. That would be something that Kiwis haven't seen, I think, since the 1980s in terms of that kind of interest rate. Yeah, look, it's hard to see exactly what the leading central bank in the world, which is the American Fed, they lead everybody and everybody else follows, with the USD being the reserve currency of the world. If the United States economy gets a sniffle, then the rest of the world gets cold. So the reality is we don't know exactly how long they're going to have to keep those elevated interest rates high. But if they have to keep them, first of all, if they have to go higher than what they had forecast, and they have to keep them there for longer to get on top of inflation, i.e. very high interest rates through 2023 and 2024, then all bets are off. I think we'll see a deceleration in consumer spending, unlike we have seen in at least a decade. And people pulled in their horns for 2 months or 3 months, like one quarter at the beginning of COVID, and then everybody went back to spending again. So we just haven't seen anything like this in a very long time. Now, you and me are probably at an age where I've seen 3-4 major recessions in my lifetime now and witnessed them firsthand. You've probably seen a couple or three. A lot of people working, particularly in tech today, they're too young to even remember the 2008 GFC. There's a tremendous amount of them that just don't even remember what that felt like and how it did feel like economic Armageddon for a while. It really did. When you see Lehman Brothers go tits up, when you see these big, massive global investment banks hit the wall and credit markets completely freeze up, people not being able to get mortgages, people not being able to get credit to do almost anything, major credit card companies going out of business. When you start seeing carnage like that in the broader economy that spills over into Main Street and its ability to even transact with each other, it's pretty serious. And we blew a bigger credit bubble between 2008 and 2021 than existed before the 2008 meltdown. It's going to be very interesting to see whether the central banks can engineer a soft landing, considering that there's so much credit that has been built up over the last decade plus that still has to be sucked out of the system from somewhere. And so assets have to devalue and there has to be a reset of major economic reset. So it's, that's probably not the kind of answer that you wanted to hear. But I think for me, what I'm trying to do is I'm trying to be super smart about any kind of debt that I would look to take on, particularly as a business. Luckily, I'm debt-free. My business is debt-free, and I haven't had to take on any funding to run my business, but not every business is in that luxurious position. And so I would just be very cautious about unit economics, particularly if I was a retailer. I would be ultra cautious about my unit economics, and I would be very cautious about taking on debt at this particular point in time, because I think that the cost of debt is going to continue to rise for the foreseeable future. And therefore, a greater and greater percentage of your income is going to go to servicing debt. And I think that's the key consideration for major retailers. Basically, if you have to make drastic changes to your business model to get you to default alive in a high interest rate environment, then you probably need to make those changes sooner than later. That means cutting costs out of the business. That typically means raising prices. Maybe you've been holding back because you've tried to be more competitive than your competitors in terms of keeping prices lower for longer. But that game only lasts so long as you can be profitable enough to be sustainable as a business. And so I think, the other thing I think that retailers would be wise to think about is the very same thing that businesses that are thinking, particularly large businesses that are thinking about laying off people, should do. If you're going to raise prices, you should raise them substantially in one hit. In other words, as opposed to raising prices 1% a month for the next 12 months and just dribbling them out to the market. No, rip the Band-Aid off, raise your prices, get the default alive, get the default profitability, and then see whether your business is actually going to be sustainable at a level of profitability, right? You will truly see how good your business is when you have to significantly raise your prices to keep up with inflation. And so I would say do that all at once. Just what we're seeing with some of these large tech companies, they're doing like a 5% reduction in force. And then 3 months later, they're doing a 15% reduction in force when they would have just been better off from a morale perspective and from a market acceptance perspective if they'd have just done 20% right up or 15% right up front, right? You prolong the pain. When you need to do something in your business, it's better to take quick, decisive, deep action and then deal with the fallout immediately, as quickly as you can, and put it behind you than it is to take your medicine slowly, right? And so I think everybody needs to take their medicine and put their business to the true test, which is how loyal are your customers? How in demand really, truly are your products? How much do your customers appreciate, respect, and love you? And how loyal are they going to be to you? Put that to the test, get the default alive and profitable, let the chips fall where they may. And hey, maybe it means you've got to make a massive pivot in your business. Maybe it means you've got to change contract manufacturers. Maybe it means you have to move countries. I was reading the other day, I think it was an Insider or one of the other online publications, how in the United States in particular, they, with all of the supply chain issues that happened, particularly with China during COVID, they have re-domiciled a whole bunch of manufacturing closer to home. And in that case, a cheaper manufacturing market than the United States is Mexico, because it's just across the border. And so Mexico has benefited massively from the supply chain issues with China, in that any domestic manufacturer of products in the United States, domestic manufacturing brand, even though they usually contract manufacture overseas, they, in order to diversify and de-risk their supply chain, they're moving a tremendous amount of manufacturing to Mexico, which is right across the border, shorter freight times, much cheaper freight, et cetera, et cetera. And I think we're starting to see that happen everywhere around the world, much more diversified supply chains. I think that China is absolutely still the number one manufacturing powerhouse on the planet. There's no arguing that. But I think most businesses, most brands, most operating brands in all of our countries, ANZ, United States, doesn't matter, I think they're realizing the danger and the risk of being so heavily concentrated in one manufacturing country, both from a raw materials perspective, from a finished goods perspective, everything, from even a labor cost perspective, because inflation is rampant in China as well, because they have become the manufacturer of the world. Skilled manufacturing workers are in demand, right? And so I think that you have to look at absolutely every single aspect of your business, particularly right now, and say, okay, we don't only need to get to default alive from a profitability perspective, but we need to try to examine all aspects of sustainability of our business. And can we live if another COVID-like situation hits our world? Are we structured in such a way that we can survive that? Are we putting away enough cash buffer? Are we structuring our business to be flexible and agile and do dual sourcing and move all of our design and IP over to another manufacturer in a completely different country using different languages, et cetera? Can we work with a local, in most manufacturing countries around the world, including China, Vietnam, Indonesia, even Mexico, for that matter? In most cases where there's contract manufacturers there are contract manufacturing brokers that operate in that country who can be your representative, that sits basically between you as the brand trying to get something contract manufactured and the manufacturer themselves. And so what they do is they effectively act as not only an introduction service, but act as a translator, and they go in and they do inspections on your behalf and make sure the raw materials are what you've been promised, and make sure that their turnaround times are happening, and the quality, and all of the, if you've got ESG goals and all sorts of other things around your goods that are being manufactured, you can effectively hire a contractor in those markets to act on your behalf with those manufacturers to make sure they're living up to everything that you expect them to live up to for the price that you're paying them. And so I think that building those kind of relationships, or at least exploring those kind of relationships in advance of when you actually need to execute on them, is very important. And reach out to your LinkedIn network. You can obviously do a bunch of Googling. There's all sorts of ways to find these individuals that represent businesses in those manufacturing markets. In India, I'm sure it's the same. I don't know specifically, but I know in Asia, those kind of representatives are very common. And so I think that setting those types of relationships up before you need them is really critical. It's building your audience on social before you ever need to monetize them. It's got to be there for you to be able to lean on it when you need them. And so that would be my immediate thinking about the whole economic side of things. Make sense?
No, it does indeed. And I think a lot of factors that you spoke about in terms of the supply chain, we did start seeing some of that. In fact, I started seeing that about a year and a half ago when COVID really hit its peak, so to speak, and both retail brands and manufacturers wanted to move a lot onshore or closer to onshore. Yeah, and it's interesting. That's what I've heard in general from the industry. We've seen good growth in terms of our customers. I think the overall numbers to go. It's also not just year on year for current customers, but also by a factor of us adding more and more customers onto the platform. So a lot of retail customers who join on the platform are talking about good results. But yeah, it's interesting times ahead. One point that you do highlight there about the credit bubble, yeah, that will definitely be interesting to watch, because who knows what's out there, and yeah, only time will tell.
Totally agree. Now, you have an interesting question, I guess, about the cookie changes. When did it start? When
Just,
will it be
just, just
completely
before,
impacted?
just
Yeah, sure.
sorry, Jason, and just before we move on to,
Sorry, I lost sound from your side. I don't know if you can hear me. I can't hear you for some reason.
okay, can you hear me?
There
Can
we
you hear
go.
me? Okay.
Yeah, I can hear you now.
Yeah,
Sorry about that.
I'm saying the changes will also be interesting to watch for the retail industry, because if spending dries up, there will be a lot of retailers who do not have their experience where it needs to be with the end customers, face some serious headwinds and challenges. And I personally believe that's where there might also be a big opportunity for consolidation, or we might just see quite a few retail businesses who do not keep pace with the changing times start to suffer, and some of those could even be fatal for the businesses, right? That's again what how I look at things, but it will be interesting to hear your perspective.
Yeah, look, I think what we're going to see, and we're already starting to see this. I've had a few companies reach out to me post COVID who were born out of COVID, and people that were either laid off or they didn't have to come into work, and so they started a side hustle. They started an online business because, of course, the TAM, the total addressable market during COVID for online sales went through the roof. Everybody was pretty much had a gun to their head to shop online, and so therefore, every Tom, Dick, and Harry that started an online store, for the most part, if you couldn't do good or do well during COVID, supply chain issues accepted here, of course. But if you could get supply and you could have an online store and you could run that effectively, the reality is if you couldn't make money during COVID, you're really not going to make money now. That's the honest truth, because your TAM has just shrunk by probably at least 50% as retail opens back up again. Because we went from, during COVID, the average penetration of e-commerce of total retail shot up to, in most markets, somewhere between 50 and 75%, right? Now, pre-COVID and now post-COVID, it ranges anywhere from about 10% to 30%, depending on the market. So we're talking that COVID doubled in most cases or tripled the TAM of most online merchants. And so they were trying to drink out of a hot fire hose basically during COVID, and now it's going back to some semblance of normalcy. And so that market, that latent market, is just not there. And so what we're seeing is that a lot of those COVID-born e-commerce websites, particularly the pure plays that are not omnichannel, they don't have a physical presence and an online presence and maybe a marketplace presence and maybe a social selling presence. If they're not truly omnichannel and they're a pure play online business that was born out of COVID, the vast majority of those are going to die. The vast majority of those are going to die. Unless they were super smart during COVID, they had a CDP in place, they really got to know their customers, they really showed an exceptional level of finger on the pulse of what their customers actually want from a product perspective, from a service perspective, from a brand perspective. If they didn't really have their finger on the pulse of that and really make hay while the sun shone in terms of collecting a lot of customer data during those heydays, if they didn't do that, and particularly if they were heavily discounting during that time, so the customers they did court were highly price sensitive customers, then they're going to really feel the pinch now. And so we're already seeing, hundreds and hundreds of pure play retail businesses going out of business that really came out of COVID and they had no future outside of that kind of forced buying online business model, right? And so you never want to rely on government to make the business model for you. That in a perfect world, that is a clear case of the government really creating a market for you. And you can never really rely on the government to create, one way or another, positively or negatively. You can't rely on the government. You got to do it all yourself. You got to own that market as much as you can. So I think that's what we're going to see. We're going to see a massive amount of consolidation in retail because of the credit bubble that's been built over the last decade plus. Money was free, VC capital was cheap and practically free, and nothing was being invested in, particularly to see brands that had no hope of profitability. Huge numbers of those were invested in with huge, ridiculous valuations, and many of them have never, ever been profitable, from Allbirds to Casper to 8 Sleep to any famous D2C brand that you care to name. None of them have made any money. They've survived purely through VC capital. And so when we start looking at that and we start thinking, well, the brands of the future, I think, that will be successful as D2C brands are those B2B brands that establish a D2C channel, right? So they've got the stability and the consistency and the economies of scale of their B2B business, but yet they have the margin to play with as a D2C brand that pure play D2C brands, which are usually just contract manufacturers, use contract manufacturers, they don't have that kind of margin to play with. And so the B2B brands that establish a D2C channel, they've got the income from their B2B sales, they got the revenue and the profitability from their B2B sales to spend on CAC in their D2C play. And if their brand is well known, then they typically don't need to spend a tremendous amount of money acquiring customers because there's enough demand in the market for their brand that the moment that they have a direct consumer play available, consumers flock to that direct to consumer play, particularly if it's a marketplace play, because the benefit of a marketplace from a user experience or customer experience perspective is it's more like a department store, it's more like a mall. It's even if you love a brand, very rarely are you going to go to that brand's website to buy just that one thing, because you typically, when you shop, most people, when they shop, they buy more than one thing when they go shopping. And so the benefit of a marketplace, for example, is the fact that maybe I can get my pair of Nikes, I can get my Lululemon joggers for my wife. On a marketplace, I can go and get all those D2C brands that are selling directly through those marketplaces. I can get them all in one hit in a consolidated basket, one shipment, and it all comes to me in a consolidated way. And so that's from a customer experience perspective, that's the win. Otherwise, if I want to go D2C shopping, I got to go to the Nike website, I got to buy a pair of shoes, then I got to go to the Lululemon website, and I got to buy the leggings, and then I got to go to 5-6 different websites D2C to buy those products, even if I love them. And so that's why marketplaces are so popular, because they have the consolidated cart functionality, being able to shop for multiple brands, not just from the brands themselves, but also from retailers, and being able to compare prices and range and all that sort of stuff in one unified place. So you can see the benefit of marketplaces, but I still think D2C plays are important to have. I think it's your home on the internet, and really it allows you to own the customer journey. If somebody does actually want to buy through you online, then they can. So yeah, that would be my take. Is I think you're right. I think you hit the nail absolutely on the head. I think there's going to be radical retail consolidation, particularly in pure play D2C land, where they're not backed by a B2B company with a long history of selling B2B. I think it is already been squeezed. I think COVID was a reprieve for a lot of retail businesses, but I think the heat's back on for sure.
Thanks for that, Jason. Appreciate it.
No worries. Now, in regards to cookie changes, this is a really interesting one. Google has been making noise about killing off third-party cookies for at least, I can remember them starting to talk about it and starting to talk about their Flock technology. This is probably at least 6, 7, maybe even 8 years ago. I remember them starting to murmur about killing off third-party cookies. And then they couldn't make their Flock technology work, and they canned that. I think 1 or 2 years ago, they canned their Flock technology. So it was like, the market was like, hang on a second, you're going to kill off third-party cookies, but you've given us zero alternative to replace it. What the hell's going on here? You need to provide us an alternative. If you're going to kill these cookies off, we need to be able to identify customers. We need to be able to have a certain level of tracking with their permission. We need to be able to remarket to them effectively and chase them around the internet. We need to be able to understand our customers. And Google has pushed back the death of third-party cookies, I think 4 times now. And their latest announcement was that it would be at least the second half of 2024 before they kill off third-party cookies. So I suspect it'll continue to get pushed back until the market stops pushing back. And I think what's happening in the meantime, and what the upshot of this, the good side of the privacy changes with iOS and with Google, which are not, they try to make it about consumer and protecting the consumer best interests in terms of privacy and safety and security, but it's not. It's very self-serving. When you own most of the first-party data on the internet, like Google does or Apple does, it becomes pretty self-serving when you kill off the access to that to small businesses. But in any case, set that debate aside for the moment and what their motives are. If we set that aside and we say, look, one upshot of this has been that the vast majority of retailers that had for many years cheap and easy digital acquisition of customers, they realize that's coming to an end. CAC is exploding across all these channels, including Amazon, including TikTok, everywhere. CAC is exploding everywhere. And what they're realizing is, hey, in order for us to even have a remote chance of keeping CAC in check, we need to know a hell of a lot more about our customers than what we do. And we need to take them for granted a lot less than we maybe perhaps have historically, because we could always replace them with another cheap and easily acquired customer. So what they're doing is that instead of just having marketing automation, which is flat out MarTech weaponry aimed at their customers, we're now starting to see the rise of CDPs as a mainstay component of the consumer commerce platform stack for retailers. And that's great, because what it's allowing retailers to do is allowing to track their behavior across all channels, and it is allowing them to understand the preferences, the demands, the needs, the wishes, the desires of their customers across those different channels, and how they behave similarly and or differently across those different channels. And it's allowing them to get to that holy grail place of more one-to-one marketing with those customers where they push out those individual segments out to their MarTech weaponry and get it out to the consumer. Now, what it's also allowing them to do, it is allowing them to create their own lookalike audiences and cohorts to then send to the likes of Google and Facebook, et cetera, which doesn't allow them to be, they're still at the mercy of, but much less at the mercy of Facebook and Google, who are saying, just trust us to create all your lookalike audiences. You give us a set of interests, you effectively give us a target, and we'll create a lookalike audience for you. You send us a bunch of email addresses, you give us the target interests, and then we'll go out and we'll find more people like them. And you just trust them that they were going to do that, right? Whereas when you send them a cohort and you say, find me people exactly like this, as opposed to saying, go and find me people with this interest, then you are saying, we've done the segmentation work. We trust our data. Google and Meta, you don't need to know what those interests are. We've already segmented for those interests. We're now going to give you a cohort. Now you go and look for more people like that. And that then returns an element of control back to the brand around the cohorts that they're targeting and doesn't leave them 100% at the mercy of these ad companies. And so there are some extreme upsides there, both in terms of the customer experience they're able to create on their own websites and through their own marketplace listings, for example. But it also allows them to slowly but surely decouple from total dependence on the ad platforms. And that's a very good thing. And when you think of quiz commerce, when you think of questionnaires that customers can go through the customer journey, particularly for highly configurable or complex products that people need to tell you what they're looking to achieve as an outcome, and then you can make recommendations of products on the website, that kind of data becomes pretty invaluable in terms of when they come back to the website and you want to craft and personalize that experience that they, so everything from the order of products that they see in a category, or the search results that are personalized and tailored to them, or if you're a fashion brand, to be able to tailor a wardrobe and send them a once a month email with recommendations based on their preferences and based on the previous buying behavior. There's lots of things you can do with this data, and brands are only just now starting to scratch the surface with how they can take that data and reintegrate it back into a personalized customer experience. They're really just starting to scratch the surface with that. From a MarTech weaponry perspective, yes, those cohorts are being sent to their marketing automation platforms, and so that way they're tailoring the content that they receive or the promotions that they receive, sure, in email, but there's many more ways to leverage that data than just in email. So brands are just starting to become aware of those expectations. When you go to Amazon, you fully expect that what is very tailored to all of the actions that you've ever taken on Amazon, from the products you've searched for, to the products you've added to your cart, to the products you've abandoned, to the categories you've looked at, to the products you maybe to products that you've compared to each other. You expect Amazon to tailor your experience very much to your history with Amazon. And I think that's becoming a bit of a default expectation everywhere across the internet. Yeah, that would be my take, is that there's downside to this in that it's been completely disruptive to businesses, and it's taken an inordinate amount of their attention away from looking after their customers to figure out, hey, how am I going to target my customers in a cookieless world and in an iOS privacy world? But that was a change that needed to happen. That always needed to happen. Brands needed to value their customers more since always. And if this has forced them to do it with a gun to their head, then I just think it's ultimately a good outcome in the end.
Yeah, no, some of our customers are taking an interesting route, especially the brands. They're also talking about putting in a consumer shopping app, which then allows them more access to the customer. And the general numbers suggest that customers are likely to interact a lot more with the brand if they've got an app installed. The conversion rates are much higher. So that's how we see some of our customers attacking this problem as well going into the future.
Yeah, it's an interesting one. The only app that it's interesting that you bring that up, because I have in the past, I think I can only remember a single retail branded app that I've installed. I used it once or twice, and then I uninstalled it, and I just used their website because I didn't feel that the app gave me enough of an incentive to continue to interact with the app versus their website. Other than that, I can't remember a single retail app that I've installed on my phone. But what I have installed is the apps from marketplaces. So AliExpress and Amazon and eBay and all of the major marketplaces that I've ever bought through, I install their app because their app experience is so vastly better than their web experience. It's just so much better in being able to track orders and being able to do all those things because you're virtually always authenticated in the app. So you just open it up and boom, it can take you to your orders page. You can see your order history, shipping history, etc. And it just makes it easier to do things like file a complaint against the seller if you need to, or get a refund or whatever the case may be. Because it effectively functions as a digital wallet as well, right then and there does make things quite a bit easier. But for some reason, have you ever installed a retail app on your phone? Because I don't know many people that have, like my wife shops a lot online, and I don't know a single retail app she's ever installed on her phone.
I have a select couple that I like shopping with, so I've got those. But yeah, we get that question a lot in terms of who's going to download the app, right? And that is a consistent question. So really, I think the answer to that from our experience has been that it's never going to be a case of everyone wanting to install your app, right? It's really those sort of what we call as the brand lawless, maybe 20% of your base, which is getting you a majority percentage of your business. And those are the guys you're really targeting with the app. You're absolutely right on with the other point about the shopping experience, where a lot of brands struggle. So for the marketplaces, they are not in retail brand business as much. They are a tech layer, and that's what enables them to differentiate. The brands historically, again, have taken that's another channel. It's working somewhere in the background. We don't pay enough attention to it. Some of our customers have actually seen the app becoming their number one e-commerce channel during the recent BC Black Friday Cyber Monday sales. So close to 45% of their e-commerce sales actually came through the app. All of our customers who work with us on the consumer shopping app platform, they've got star ratings of close to 4.8, 4.9 across a review base. And most important factor has just been the conversion factor. So if you have 100 people coming in or 100 people shopping with you on mobile web, the conversion rates on the mobile app for us on an average are generally 3 to 5%. There are a couple of 3 to 5 times, not percent. It's really a 300 to 500% jump in terms of conversions. And a couple of brands are just complete outliers. They've seen conversions go up to 700%. Now, we can attribute this maybe to a poor earlier mobile web shopping experience, but brands are in that stage where they have invested heavily on their e-commerce platforms, but can't really be very agile with that. And the reality is 60-70% of the shopping that happens today happens on mobiles, right? It is happening on mobile devices, and that's where we're seeing that change come in as well.
Nice. Yeah, look, I think if you can create an incentive that is unique to using the app, that the app does something that's different to your mobilized website, your standard responsive website. I think if you offer some very clear and tangible benefits that you can really only get using the app, I think that then creates an incentive model whereby people do want to install the app because, hey, I can't get these X 2 or 3 things, or these 2 or 3 experiential elements, or I can't get maybe when shopping through the app, for example, the free shipping threshold is lower, for example, or when you're using the app, if you've got a loyalty program, you get more loyalty benefits by using the app than you do by using the e-commerce website, etc. So I think if you can differentiate and make it a unique experience, a really good unique experience, combined with some unique incentives, then I could see a reason to justify that kind of investment into a mobile experience.
Yeah, no, that's bang on, because some of our customers are talking about doing their first drops only on the apps, for example. Some are talking about creating a specialized premium offering, which could be a custom offering for you, which just on the app, you can't get it online on their website. So you're absolutely right with that. It has to have definitely user experience itself is a big differentiator, but what more can you do to drive that adoption is what we see a lot of brands asking.
There's two interesting things that I just experienced recently that is really in line with this discussion, which is that TradeMe, which is a marketplace here in New Zealand, very big marketplace, which I'm sure they just introduced. Well, I don't actually know exactly when they introduced it, but as far as I'm aware, it was introduced fairly recently because I never saw it before until very recently. They introduced the ability, so when you run an auction on TradeMe, you can obviously set a reserve, et cetera, et cetera. You can set a buy now, all that sort of stuff. But what they've done is only in the mobile app version of the platform can you make an offer as a buyer. Can't do it through the standard browser experience. So if you want to make an offer, so let's say the reserve's $100. If you want to make an offer of $80, you can only do that through the mobile app. So basically, if you want to negotiate, you can only do it via the app. Then I saw Facebook Market did something similar, but through their mobile app is the only way that through Facebook Marketplace, you can give buyer and seller feedback. You cannot do it through the mobile Facebook, the web Facebook experience. You can only do it through the Facebook app on the Marketplace tab in the Facebook app. So definitely there are some benefits, some enhanced experiential things happening here if you're using their apps versus their standard desktop browser-based experience. So yeah, definitely there's definitely, I can see some moves behind the scenes. Now, both of these admittedly are basically marketplaces, but definitely I think your retail brands could take a page out of those type of books where they say, okay, if you really want to get the full experience, like if you want to get all the benefits of interacting with our brand, then you definitely want the mobile app because you don't want to miss out, basically. And maybe even if you say as a brand, okay, I'm going to roll out these 3 new features, functions, offers, benefits, whatever they are, and maybe for the first 6 months after release, you can only get them through the app. But then we'll backport those into the web experience, but we're going to do it later. So if you want the first, then yeah, absolutely. Make sense?
Yeah, no, agreed.
Nice. Now we had another talking point here, but why don't we leave that to our next discussion, because this is a deep one. I think it's going to take us a bit of time to unpick. I did a post specifically about this today, so your final conversation we'll leave this topic for the next one, but we'll just tease it a little bit here. We talked about buy with Prime changes. What's its impact on brands, marketplaces, the industry, commercial model? What does that look like? What is the broader impact, the secular impact of these changes? And Amazon saying that by January 31st, they will have buy with Prime available to all US-based merchants. Now, they haven't said globally what's going to happen with that, but at least the US-based merchants by the end of January. So definitely this is a major thing to discuss. I think we will probably spend 20 minutes at least talking about this. So we can definitely save that for the next conversation. Sound like a plan?
Yeah, well, that sounds great.
Awesome.
Thanks.
If you'd like to get mentored by Jason for free, head over to greenwoodconsulting.net, scroll to the bottom of the page, and click Get Mentored by Jason.